Yeah. So a little history about the I guess the 2-1 buy down. I think it actually was. It's not a new program that's just come out, but it's something that's sort of been reintroduced. As we've seen a lot of new products that we've had in the past come back after COVID. When COVID hit, things got super strict, and they basically wanted, unicorn borrowers to, 10 years at the same job, W-2, increasing income year over year, all the things that, make for a great borrower. But now we're in a market where, just like a lot of you guys as realtors are, seeing less activity, so are every lender. So they're coming out with more products. And, this 2-1 buy down was actually probably targeting sellers more than anything, to allow their house to kind of stand out, and, to avoid potentially getting someone into their house with at least an introductory payment that was really enticing compared to, just the flat rate that they qualify for. And, for a seller, it could be a $20,000 seller credit versus a $50,000 price reduction. So the seller ultimately could be netting a higher amount of money, selling it to that same buyer. And that's kind of where this started and you probably see it go back and forth between being a benefit to a buyer and a benefit to a seller. And it is one of these unique products or strategies, let's say, that allow it to be a tool that, a real estate agent could use to entice either a buyer or a seller. And, working with us, I think, allows you to walk into a listing appointment and, have more information to share on this, of how this could benefit your potential new client before they've even have to start negotiating. So now you're walking in, you have your typical marketing plan and everything else, and you're laying down one more option, which is, hey, we're in a situation where a lot of your, competition is lowering the price because rates are going up. Here's an option that we can use to help this, your property stand out and be enticing to a buyer. And there's a lot of ways to market that, adding to your kind of arsenal of tools to make it seem like you're the right agent to work with, because you're, up to speed on everything that's going on. So I think the 2-1 buy down is really cool. I feel like beneficially, it's probably a really powerful marketing tool versus a financial money saver. It's not really saving any money at all. It's just reusing someone else's money for the borrower. But at the end of the day, I guess the borrower would potentially be saving money if they chose to use that credit towards the buy down. So hopefully Brian will be on soon, and he can kind of give you guys a little bit more detail on it from his point of view. I can certainly give you mine, but I don't want to step on his toes. I don't know exactly how he's pitching this thing. If you have questions right now, go ahead and just shoot them into the chat, and we'll go from there. I'm not sure where he is.
He's coming in now. We had the links confused here, so
what? We do that a lot.
I just unmuted myself. Can you guys hear me?
There you go.
All right.
Can you guys hear me?
Yep.
Am I joining as a panelist or as an attendee?
You should be as a panelist.
All right.
Let me see here. There you go. And then I'm going to make you a co-host. So if you need to share your screen, you should be able to now.
Yeah, I've been promoted to panelist.
You are promoted. You got promoted twice.
Yeah. Well, the first time I screwed up, I guess. I didn't realize the links were different. So I had a good conversation with Paul and Amy. But should I be sharing my screen?
Yeah, go ahead and share your screen.
I can figure that out. Let's see here.
Controls
partic-
are maybe at the top or bottom. It says green, new,
It'll
share.
stop the other screen share. Okay, yes. There we go. Think I did that. Now share.
Boom. There you go.
Can you see my setup there?
Yep.
All right, great.
So
Sorry
to
guys,
give
I'm
you-
late. Like I said, I think we clicked on the wrong link.
yeah, that was
Oh, you want to
my
see?
bad, I think.
Maybe if you want to see my face, should I fire up my video? Here we go.
Yeah, if you want.
There you
Go
go.
for it. Cool.
Look at my bald head. Me and
There you go.
Travis. Yeah,
Okay.
take your pick.
So just to let you know, we have both our LO team and quite a bit of our real estate team on here today. They're the ones out here kind of on the front lines, you know, putting this material in the listing. You know, if they have a listing, we've been encouraging them to, you know, offer some of these types of programs so that we can get the listing sold a little faster, try and do some cross quals with our team as well. And then also just starting up conversations with buyers, because, you know, everybody's, you know, rate, I'm going to hold off. But if we can talk payment instead and how we can, you know, get through the next couple of years with a more affordable payment, then I think that this is the great product for that. So there's been a lot of confusion, not confusion, but, you know, not everybody knows exactly what the 2-1 is, how it works. So we thought, you know, going direct to the source, having our account executive from UWM come on and explain the product that UWM has. And then if you want to give any sort of a background on UWM, you can as well. But we are, you know, we broker through UWM quite a bit. They're our preferred lender for brokering loans. So, and with the biggest wholesaler in the nation, right?
Yep.
Right.
Biggest wholesaler, and we may be the largest lender period here after the third quarter. So I think we've making some ground, you know, because a lot of the lenders have the retail and wholesale division, but we only have wholesale. And but I think we've may have gotten that title. We'll update you when we get the confirmation.
All right.
Anyway, so thank you very much, Travis. I'm excited to talk with you guys. And, you know, I think the big thing, to your point, Travis, about, you know, the rates doing what they're doing is you want to make sure the borrowers don't, you know, that they don't fall in love with this loan as being their life loan, the last loan they're going to have in their life. I think what you need to let them know is that, listen, we've got the technology, and this is something UWM has specifically. We have the technology to let you know exactly when you're able to save your borrower money and to refi them into their next opportunity to save money, but get them into the home that they're excited about. You know, buying a home is a very passionate decision, and they're excited. And if you've got to be that voice of positivity and get them to take action if that's really what they want. And that temporary rate buy down is a program that allows them to do just that. You know, with rates having gone up a little bit the way they have, you know, the temporary rate buy down, just, I guess, to simplify it, the 2-1 buy down allows you, the borrower, on the first year to make a payment that's on interest rate 2 percentage points less than the note rate. And then the second year, the borrower makes a payment on 1 percentage point less. And then the third year, who wants to chime in and tell me what the third year payment's going to be?
The rate they qualified on, right?
No, Travis.
No.
The third year, by then we're going to be able to refi them into
yes.
better rate. So
hopefully
that's
that would be the low rate by then.
Right. No, so and I think that's the way to think about these things. You know, the market's cyclical, and you know what we see is that, you know, if you can get these guys into a program now for 2 percentage points less, it's a big deal. And especially when you're buying a new home and there's costs associated with that, you know, furniture, whatever. You guys all know that there's some costs associated with getting a new home. And that's really impactful, the savings that you can experience paying principal and interest 2 percentage points less. So that's the idea there. And so sometimes it's going to be that you know, they need to be able to afford furniture. Sometimes it's going to be, well, they know that they've got a big bonus coming at the end of the year, or big, you know, pay increase. So they'll be able to afford a larger payment later on. And again, you refi them as soon as you can. But that is the way the program works, is they get that savings at the front end of the loan. And then when the time's right, you can refi them again. Now, there's a 2-1 buy down, and I'll spend most of the time talking about that. There's also a 1-0 buy down, which is really the same thing, only that first year it's 1 percentage point less, and then the second year it goes to the note rate if you don't have the chance to refi. So where that's handy is, you know, so a lot of the questions I get is, where is the savings coming from? Does the borrower have to pay anything towards it? And the answer is no. The borrower doesn't pay anything. The buy down is done through seller concessions. So you got to have a seller who's willing to come up with that money. Now, the seller can negotiate, you know, the purchase price to reflect that there's going to be some concessions there if they need to bump that up, or instead of negotiating down from asking, maybe you pay asking and the seller gives some money back in concessions. But we're seeing a lot more of those seller concessions now than we were, you know, several months ago, when you were seeing, you know, 30 offers, a lot of them being cash offers. It was hard to, you know, those properties were moving very quickly, and it was very competitive. Now it's not so much. We're outside of the typical purchase season, and a lot of these homeowners, these sellers, want to move their properties, as do the real estate agents. So keep that in mind. We're seeing most activity with the 2-1 buy down, so as opposed to 1-0. So what types of loans do these affect? We offer the 2-1 buy down for purchases. For conventional loans, we're doing them, let's see, for conventional and then FHA and VA. For FHA and VA, for the government loans, it's going to be for primary only, and for conventional, we're doing primary and second homes. So keep that in mind. I've just got some. Now, this is a great tool here. You know, on the source, if you go up to the upper left of the screen when you log into uwm.com, search the source, hit that button, and then use the search bar up here to search for temporary rate buy down. This is, I think, the first thing that comes up, and it just gives you a description of the program. And you can see here the parameters: FHA, VA, conventional purchases, and it talks a little bit about this, where you see Section 8 fee screen. That's where you're going to see the concessions come in. Now, the one question I get a lot is, well, is there an advantage? What's the difference between temporary rate buy down and just buying down the rate? You know, those are two ways that you can get a better interest rate. This is definitely better if you have a choice, for a few reasons. Number one, when you buy down the rate, the borrower's paying for that, right? Borrowers, that's going to be a charge to the borrower. Number two is the whatever benefit you get from buying down the rate, that's for the entire 30-year term of that loan, right? So if you ever refinance out of that loan, you don't really get any benefit from the years that you weren't a part of that loan. So it's kind of spread out over the entire time. And then
the cost of doing the initial buy down as
well, that's
right?
what I'm saying is, well, no, the cost of it, you're paying up front, and then that benefit is spread out over 30 years. So that's one thing to keep in mind. And then when you refi out of it, you lose the rest of the benefit. So the difference here with temporary rate buy down is you're smushing all of that benefit into the first 2 years. Okay. And the other thing is, of course, the borrower is not paying for that. So if you have a seller who's willing to work with you, the seller's paying for it. The borrower gets all of that benefit in the first 2 years. And if, let's say, rates get better in the next year and you want to refi out of this program into another loan, and there's still some seller's concessions in the loan, that's the borrower's money. So the borrower gets that to help pay off the loan. So that's an important point too to make, is that the borrower doesn't lose any benefit once the seller's concession.
Where does that go? So let's say we're just starting year 2
Yep.
And they've got, I don't know, $5,000 sitting available still. Do
Uh-huh.
they get that applied towards their closing costs, or is that applied
It's
for
part of the
principal
pay.
reduction, or what happens?
It's used to pay off the loan.
Okay.
So if you're doing a refi, it would just be used to pay off.
Okay, so that
just
would be
come off the
principal
loan.
reduction, right?
Yep,
Yeah.
exactly. So anyway, they get the benefit of it. So that's a really nice feature that with this program. So now the other question I get quite often is, well, how do I know exactly what the buy down amount is? And it really this amount of seller's concession is going to be exactly the savings that the borrower experiences during that first year and the second year in the 2-1 buy down. And again, to see that, you'd go to the source, search for buy down calculator, and you'll get a calculator that comes up that I'll show you right here. Let's see if I can, I'll make that a little bit bigger for you. So this is just an example that we put together here. So you can see, it makes it very easy to determine the amount of the buy down, the concessions. So you put in your loan amount, you put in your purchase price, it's an Excel document, and then you put in an interest rate for the loan. It's going to be 30 years, 12 payments a year, monthly payment at the note rate. And then you'll see right here, year one, instead of 7.25, you got 5.25. And there's the note rate payment, then the buy down payment here. So your monthly savings is here. And so that times 12 is going to give you this number. And then year two, you can see it's not quite as much because it's a percentage point more. But you'd add obviously the 2 years together to get your total amount of concessions there. And that's the number that the seller would need to contribute there.
So we need about 2%.
Yeah,
if
that's what
we're
it ends up
talking
being.
Percentages, for everybody, the real estate agents out there, if you're writing up these offers, looks like you're going to target about 2% towards this buy down is what you want to be putting in the offers.
Yep. And let's see here. And then this is just an example on the 1-0 buy down. So my point before, if a seller isn't so keen on putting in so much extra money, perhaps they'll be more open to less. And if that makes the deal work, that can also be helpful because listen, a percentage point it can be meaningful also, right? So
still saving $365 a month on that one.
And so like, if you look at that, it's a car payment, right? I mean, it's substantial, and it can be enough to make a deal work. So it's something to definitely to keep in mind.
And $5,000 on a $650,000 sale is, in my opinion, not very much, to ask for. So that should be able to be pretty easily negotiated in this market, in my opinion, for most properties.
Yeah, and like I say, some feedback I get from people that I talk to about is like, oh, my area, they're not doing the concessions. I would challenge you to really get out there and make sure that that's the case, because we are seeing a lot of it. And don't be shy about approaching that topic, because again, people want to move their homes now, and we're at that time of year where homes aren't moving as quickly as they were. So
yeah, I agree.
So that can be helpful. Trying to think if anybody has questions, feel free to ask.
You can throw them down in the chat, and then I'll ask them, or I can unmute you. Either way. So now's the time. We have a captive account executive here who can answer the questions directly from the source. So
trying to see if there's anything else in the sheet here that would be meaningful for you guys. But you can all look at this when you get a chance if you pull it up from the source. Temporary rate buy down.
Brian,
some calculation examples. So,
now, someone who doesn't have a UWM account, can they access this? Is this public facing?
Probably not. Yeah.
What about the calculator?
If you can't get onto uwm.com, it would be interesting. I don't think you can use the source if you don't have if you're not logged in.
Okay. What about the calculator?
Try it.
Is that
the calculator is going to come from the source also.
Okay.
But I would maybe try it. I don't know offhand.
Yeah, maybe I'll grab it and see I could do it without logging in. So that'd be a useful tool, I think, for a lot of the agents. But I think mostly if we're looking for, you know, a 2-1 buy down for your borrower, just think, you know, if you can get that 2%, you're going to be right in there, maybe plus or minus a little bit based on the sales price of the home. But, you know, that was a fairly average price, I guess, for, you know, that's maybe a median, you know, for here. I know you're back east, but
Yeah.
you know, if it's a larger home, you might need a little more. But target that 2%, or if you can get, you know, the 3%, if they were doing this loan as a conventional, they could get up to 3% in seller concession for this particular loan. So I would go for the full 3% in your offer. That'll leave a little bit of extra money for closing costs on top of what this is going to cost here. But, you know, for me, the major takeaways are going to be, it's the borrower's money. You know, it's, I guess, for lack of a better term, it's kind of a Band-Aid solution for getting through this market pinch that we're in right now, where we don't have a lot of direction. Rates still may go up a little bit. People are interested in buying a home, but, you know, there's articles and news things being thrown at them left and right. You know, for me, this is a really, really good solution to get borrowers excited about buying. You know, when you're talking a 5.25 versus a 7.25, that sounds a whole lot better, you know?
Sure.
So, and if, you know, things change next year, maybe late in the year, rates start looking a little better and they want to, you know, get into that a 30-year fix and take advantage of a lower rate, then they still have money in the account and it goes towards their principal reduction. So, and that's another piece there. You know, I just saw an article yesterday that Zillow readjusted their projections for 2023, and they're still projecting a 1.7% increase in values across the nation. We're not talking California. So, you know, there are some markets that I think we are going to see some, you know, some decline in prices. You know, that extra money could also help offset that if they end up refining a little early. So, you know, I think there's a few angles here that we can hit with talking to borrowers about this product and educating them on what it actually is and how it's a benefit.
And let me just add real quickly, just to avoid confusion, just so everyone knows, this is not a qualification play, right? So you're going to have to still qualify the borrower at the new rate.
Yep.
It's purely, you know, have that lower payment. And along those same lines, don't panic when you don't see the payment show, the lower payment on the CD. So the CD is not going to show any of the buy down part, and the reason for that is because that's not what we're qualifying on. But in the final package, it'll clearly show what the payments are and everything. So
yeah, that's almost a good safety net for the borrower too, is they have
right.
to qualify for this home off of this rate. So if rates improve, it's only going to improve the affordability of their home once they go to refi. So I actually think that's a good safety net to keep the borrower safe from, you know, overextending
Sure.
what they could, you know, purchase in a home. So
yeah, and then, you know, another thing that we're seeing sometimes is matching up this sort of a program with another program that we have, like our Borrow Smart. I don't know how familiar everyone is. I've talked to most of you about Borrow Smart, which is you know, if you were going to look at Home Ready, Home Possible, it follows the same guidelines as Home Possible, 3% down, but it gives you down payment assistance. Now you got to qualify at less than 80% of the AMI to get $1,250 of down payment assistance, and then $2,500 down payment assistance if they're less than 50% of AMI. And I understand there's some, you know, issues with finding a home with that sort of a program, but imagine, you know, there's less LLPAs on those for those loans, and if you can combine that sort of a thing with a temporary rate buy down, you know, it certainly looks good. It just comes down to finding a home.
Yeah, definitely. So they work good in some regions and not quite as good in other regions, but
Right.
it is an option for a lot of people, depending
Sure.
on where they are. So
Yeah.
cool. Well, if we don't have any other questions, are you guys gonna be rolling out any UWM specific down payment assistance programs?
Well, we do have, if you search the source, we do have a document that shows all of the down payment assistance programs that we've already had, that we've approved. So it's not that's in there, so you can see what programs we have currently. Now we're open to other ideas. So if you have a specific down payment assistance program you want us to evaluate and tell you whether we'll do it or not, you can have the whoever the provider is fill out. There's a like an approval. I can send you the document if you want. Travis, I'll send it to you. And it basically, they would fill that out. You email it to dpa@uwm.com, and we'll evaluate it and get back to you, let you know if we can use that program.
Okay. Yeah, that'd be
So,
cool.
yeah, but if you have any
Excellent.
questions, any of you, feel free to follow up with me directly. I'm happy to help you and wish you luck. But it's a great program, and we'll keep rolling stuff out. But we're getting a lot of activity here, so hopefully that'll be a
I'm sure.
benefit.
Is this one of your more popular products right now?
Yeah, right now it is. And I think, like we all see right now, people are interested in getting that rate as far down as they can. And this is a great opportunity to do that and have some benefit there.
And one other question that's, I guess, not super related, and maybe you have these numbers, maybe you don't. Have you seen a decrease in what people are willing to put down on a home? So are you seeing less 20% downs and more like 10 or 5% conventionals?
I would say, I don't know around across the table, but I have not seen that. I see a lot of 20% down, but I also see, I see a lot of 5% too. Our mortgage insurance, borrower paid mortgage insurance is the best priced out there. So, and then if you get into a competitive situation, make sure that you're evaluating the payment as opposed to just the rate. We're running our game on pricing right now. So our pricing is relatively great. But that overall price is going to be better if mortgage insurance is included, because we're always going to be real competitive on the mortgage insurance part.
Yeah. Okay.
So
cool. Well, I appreciate your time, and thanks for coming on and giving us the overview on what this 2-1 looks like for everyone. And hopefully we can get some more stuff over to you, and hopefully this helped everybody as well. So feel free to reach out to the loan team if you have any additional questions. But this is how the 2-1 works, and I would definitely have these conversations with your borrowers, or if you're on the listing side, advertise this kind of stuff. It will help your listing sell. So, and if they have questions, you can direct them to the loan team as well. So,
thanks Travis, and everyone. I appreciate all your time.
Yep. Thanks a lot, Brian.
All righty. We'll see you guys.
We'll see you. All right, guys. We'll see you. Thanks for coming on, and we will do another one of these next month. Third Wednesday of each month, we'll do this Trending Now webinar. So thanks for attending. I know it was a little bit short notice, but I really appreciate everybody coming on. Thanks a lot.